Morning, everyone. Welcome to this morning's edition of the MPC Markets Morning Call, 27th of November, 2025. I'm Mark Gardner. The turkey trap rally continued overnight, essentially through these really quiet periods over the course of, the Thanksgivings over the years. I've just noticed the volume has lightened. Well, the volume lightens, which it has. I think volumes are down about 30% as of yesterday, and probably down a little bit more again overnight against the 30 and the 10-day average volumes. And every morning I'm coming in and essentially reading the same news story, just recycled, rewritten. That news cycle or media cycle grab for constant content. But the rally last night, justified by multiple news agencies and pundits and financial websites to be, was Monday's news basically, and really it's just been recycled and the rally's gone again. So it's commonly referred to as the turkey trap, quiet markets, and we have some pretty significant moves which just get compounded on the back of lack of news flow, thin volumes. What I personally think is going to end up happening now is I don't think the rate expectations for 80%, 85% of chance of a rate cut, up from 20% last week. There is no way on God's green earth that there is anything that justifies that sort of movement. But when you with algorithms the way they are these days, that would the rate cut optimism would be the trending article. It would be helping sentiment, etc., etc., etc. Nothing's changed since last Friday, except for one comment from one Fed member against 6 or 7 other Fed members that have said the opposite. And that news story is just being recycled and fed upon itself. But look, good thing for investors. You got the Russell up 5 or 6%. I think the downside to this is that we're just lining ourselves up for a significant disappointment, and all of these gains here, like 2% in the 3% in the Dow, 2.5% in the S&P and the Nasdaq, and 6% in the Russell, can very easily be unwounded, and plus that again. So I think we're very much lining ourselves up, for a fall. It feels like I'm watching my kids do something silly and they're about to hurt themselves, and I'm just wincing at the moment because it's a silly rally on light volume. So we did have some news out of Dell last night. Their revenue was slightly better than expected. But HP had weaker guidance. I mean, really, they do these servers or whatever, but we're not talking Google or Nvidia here. I don't think they're now just using the Dell news as justification for AI optimism, whereas Dell's not even in the conversation. It's a fringe player in AI. So really there's not a hell of a lot to cover, to be honest. I think the one thing that this rally has done is salvaged the momentum that was really looking very poor. But look, I'm not going to pick a direction in this market until we see Tuesday, Wednesday next week. Core PCE data was expected out last night, got cancelled, won't be until the 5th of December now. That was a pretty key piece of inflation data. Aussie inflation data was out yesterday. It was much higher than expected. There's a number of headline-grabbing pundits and economists or whatever in the paper today now calling rate hikes. Look, you've got to go back to the historical averages. That's absolute garbage. What they're saying, they're just all hunting for a headline. So I would flick past those pages and not bother reading most of it because they're having one rate cut in a cycle is very rare, let alone flipping it on its head within 6 months. So essentially, just take the names down of the journalists that have written that, and just probably take them off your list of of people to read in future, because it's absolutely absurd, and just irresponsible talk, basically, to try and grab a headline. So when we do have inflation here in Australia, we haven't cut rates as much as everyone else has. The RBA is managing it well. The media just needs to shut up. Having a look at the market map here at the moment, Nvidia made a small recovery. Google just drifted off a little bit, but it's been a really hot run in Google, only off 1%. Broadcom's still rallying. Oracle made a bounce back, but was after a pretty horrible run, really. Look, it was just broadly green, I suppose. A little bit of heat out of the healthcare sector, but again, these appear. We won't bother doing the morning pod tomorrow. Thanksgiving, markets will be shut. I'm as opposed to the media and the pundits that essentially end up focusing on things like European markets or whatever that we don't care about generally, unless there's a public holiday in the States. I'd rather give everyone the day off than talk about things that are largely irrelevant, and then we go back to the market here. So, but yeah, overall, this was one of the things I said this week. I was going to try to utilise this time a little bit better. We did the capex expenditures yesterday for Amazon. We did the GPUs versus TPUs. The day before that, but this is just a bit of a wrap up of the mega cap companies and their debt issuance in the last few weeks. Amazon's issued 15 billion, Oracle's issued 18 billion. Their Verizon is 11 billion. Google's done 17.5 billion US, and then a further 6.5 billion euro, and then Meta's up to 30 billion. So, their debt outstanding is obviously at the moment. Oracle is of major concern. Verizon would be a fairly large concern as well. These guys, I think, debt to equity ratios wouldn't be the biggest of deals, but you can just see that their outstanding debts are only, for Amazon, it's only 70. For Meta particularly, it's around about 60. And half of that has been issued in the last week. Has been added to it. They're essentially paying it to individuals for AI hiring. It's quite a big play. So it's not of concern. But it was more of a broader context of where they're getting all this money, the cash flows and things. If you're issuing significant amounts of debt like this, you can kind of tie it to AI infrastructure, and it's usually a good way to get low cost financing, as opposed to because I would assume it would be securitized. So I dare say that's why they're doing it. But there's some fairly alarmist headlines around that how much debt they're issuing. The only ones really, I think we're at a 400 or 500% debt to equity ratio for Oracle. That is of concern. However, it is quite common for infrastructure plays, and I think Oracle's kind of one of them. Infrastructure plays to have debt to equity ratios of 200 to 300%. So 400 to 500 is silly and high, but it needs to be monitored. But the likes of Transurban, for instance, is a debt to equity ratio in extraordinarily high for ages, but once you own the road and you own the toll road and you own the income, it pretty kind of similar thing, I suppose, but just on a global massive scale. But this really does prove the rapid expansion of data center sort of thesis. A lot of it's been spent on power and things as well, and nuclear and natural gas, etc. There's essentially all this is going to get funneled straight into that capex expenditure for data centers. So there'll be a lot of things like copper, things like water, things like nuclear or power management systems. aluminium and these major capex expenditures normally reserved for governments, but these guys have got more money than governments now because they don't pay any tax. Um, they're you know they're this is effectively stimulus almost in a way. It's just that it's coming from private companies rather than the government. And look, and it's good. It's good that the system is piling it back in because so when the tactics that these guys employ for tax optimization means that the government can't really afford to push out that infrastructure anymore. So it really does fall on them to do it in the end. No earnings, Thanksgiving calendar, we can just ignore. Gold was up again overnight, 1%. My old mate silver was up nearly 4% overnight. We're back around that 53 level. There could be a little sneaky rally here and a bust up to the upside on thin volume. These are periods where you can get these little flash moves. Because most people are away, and Thanksgiving's a massive holiday in the States. Copper was up a couple of percent as well. The US dollar fell 0.2, which that helps it a little bit, but that was a pretty significant rally in those commodities last night. Crude was up a little as well. Lithium, uranium, and Bitcoin all up 3%. And that's more of the lithium, uranium, and Bitcoin is more just a stabilization or reversal of the trend. I think lithium prices went up pretty significantly the other day. But as far as the Aussie market goes today, we're up about 20 points in the SPY. There's a couple of decent corporate stories today. WiseTech's appointed Raylene Murphy is an independent director. So finally, they've got an adult in the room. Hopefully, she's got a really good track record and worked at a number of ASX listed companies. So hopefully, the children are being watched at WiseTech. And I think that's going to bring a lot of investor, it's going to reassure investors that there's now an adult in the room and not just a founding dictator. Reece is launching a $35 million on-market buyback, which is pretty positive as well. Retail food groups posted some lift in the same-store sales, and then Megaport's completed an acquisition. As I said, there'll be a lot of talk today about rate hikes and headline grabbing, and it's just clickbait. I'd just be ignoring it overall. I think we should have an okay day. There's been some okay stories come through. If there's inflation, it does tend to mean that things are going fairly well, as much as Australians like to complain. Things have been relatively good, basically. So yeah, I don't expect a major rally, but we probably just keep an eye on commodities today and have a look. I would say WiseTech's a pretty good buying opportunity here at the moment. So a little bonus buy for you there. But as I said before, we won't bother with the morning podcast tomorrow because it's Thanksgiving. So just enjoy your day and we'll chat again on Monday. Have a great weekend. Bye. General advice warning. The content presented in this presentation is intended for informational purposes only and provides general advice only. It does not take into account your personal objectives, financial situation, or specific needs. This information should not be the sole resource when making investment decisions. We strongly recommend you seek the advice of a financial professional.